Hello and happy Thursday. Welcome to a Purse Strings Lunch and Learn. We're so excited to be in this group this year and bring some of our expertise. For those of you that are new, Purse Strings is here to provide some tips, tricks, pieces of advice to get the wheels turning on all financial topics. And then when you're ready to start planning for retirement, getting a will, long-term care insurance, getting a divorce, any of these different things, we have top tier financial professionals ready, willing, and able to help you. Those are what we call our purse strings approved professionals, and Jacob here is one of them. So we're so excited to have Jacob on to talk about getting ready for retirement, which I know is a top of mind question. But before we dive into all of that fun, Jacob, could we get a little intro of who you are and what you do?
Oh my goodness, Maggie. Well, thank you so much. And even before I go ahead and start talking more about me, I would like to just thank Maggie for who she is, thank Barbara for
Yeah.
who she is, and be able to thank the entire Purse Strings Network. I think it's so amazing that these two ladies have come together to build a wonderful program to be able to help with financial literacy, information dissemination, and being able to help link qualified people with ladies who want to be able to improve and better themselves and improve their overall situation. So huge kudos to Purse Strings,
Well, thank
huge
you.
kudos to Maggie and to Barbara, and as well as all of you ladies who are joining us today. Thank you so much. So with that, I am Jacob Jeagle. I'm a certified financial planner, and I specialize in financial planning and investments. Retirement planning is one of the things that we do here, but beyond retirement planning, I'm also a Social Security expert. I'm a cash flow and budget expert. We spend a lot of time in taxes. If you know a little bit about the firm that I work with, we have a lot of CPAs on staff, enrolled agents, and even a few tax attorneys. So tax is a big focus for who we are and what we do, as well as estate planning. I've been in financial services since 2006. I've held my CFP since 2014, so 8 years now. And I love being able to help people along their financial journey. And big fun financial journeys are when we're able to turn off work and turn on the fun. And that easy coined term is called retirement. So I'm looking forward to being able to talk through with all of you ladies about retirement and what retirement preparedness can mean and look like.
Awesome. Well, we're so excited to have you on and to dive into this. If anyone does have any questions along the way, feel free to pop them in the chat. We're happy to help you out there. And if you are watching the replay, you can still pop them in the chat and we'll work on getting back to those as well. So let's just dive into all this fun. Where do we even begin to prepare for retirement? Where do we even start?
Goodness gracious, Maggie, what a simple but very loaded question. When it comes to
Right.
being able to prepare for retirement, I have a lot of questions that come about in even just the starting phases. And what we like to do is we like to be able to put together three essential things: the net worth statement, your cash flow or your budget, and also your taxes. Those are three things that are really important to look at. And by either a show of hands, a nod, or maybe a comment or a like, who's heard of a net worth statement?
I'm seeing some likes here.
Perfect. I love that. So, what we want to do is we want to be able to accurately put together what you own and look at it against what you owe. So, when we're looking at those things together, we want to be able to put together everything from the bank checking accounts. We want to put the savings account balance on there, how much you have maybe in an IRA or a qualified retirement account. We want to list in there how much you have in your employer sponsored retirement plans, those 401ks and 403bs. From there, we want to list things like your cars. Maybe you own a home. Maybe you own some real estate or land. We want all of those things listed and labeled. And that's all under a category of what you own. What you own, we call those assets. And then we want to look at them against what you owe. What you owe is another term as debt or as liabilities. And that could be anything as simple as maybe a credit card or a home equity line of credit to a mortgage or maybe a car loan or maybe a 401k loan. Everything that you owe, we want to be able to add up everything that you owe. Take up everything that you own minus what you owe, and you're left with your equity. You're left with your net worth. And that's one of the best places to start. In handling clients over the last decade and being able to work with real life situations and see it across the spectrum, that's actually surprising how many clients don't have a net worth statement put together.
Yeah.
So cataloging, that's the first place. The next is being able to document your cash flow or where your money comes from. When it comes to retirement, some of the sources that we typically see would be Social Security income, maybe it's pension income. We might have alimony that would need to be factored in. Or lastly, it could be income from the portfolio, maybe an annuity income, or even some private partnership, some LLC, some business that you have a relationship to that would pay money out to you. So let's look at all those income sources and have that be the second document that we're looking at when it comes to retirement preparedness. The third piece is taxes. Let's take a look at the last 2 to 3 years worth of tax returns, because we want to make sure that the income that you're receiving it as tax efficient as possible. So there's a lot of strategies that you can do within the overall tax world, but being able to document what you have, your net worth, being able to document what you are going to receive in your cash flow, and also be able to see what's the tax cost of having those communicate together, that's going to be a really, really important way to start your retirement journey.
I love that. It's a great way to get set up and just to almost just to see where you're at, have a kind of a marker of knowing where you're at, where your money's coming in, where it's going out, have all that great information. And so I know then a lot of times people ask, how much cash should you have on hand? We have all these different accounts and things like that. So how much cash do we really need to have, in the bank?
Very important question. And this one, unfortunately, I'm not going to have any secret sauce, but I probably will steal a page from maybe Susie Orman or maybe Dave Ramsey. And in terms of the cash that we want to have set aside and in reserves is 3 to 6 months of expenses. Now, I've had some people push back and say that feels like it's a lot, but when you look at it objectively, it's there for a very, very purposeful reason. And the reason being is because of years just like this year and years like we saw 2 years ago. When the market's down, we don't want to have to sell from a down investment or a down asset if we don't have to. And one of the best ways that we can avoid those financial pitfalls is being prepared. Now, let's say, for instance, that you spend $5,000 a month. That might include the mortgage, the car payment, going out to eat, and even some travel expenses. Let's say that you spend $5,000 per month. Well, over the course of 3 to 6 months, that could be an emergency fund somewhere to the tune of $15,000 up to $30,000. Now, why the spread or why the difference? And that would come down to the way that you're getting your income. So let's say, for instance, that you're just only living on the portfolio, or you're just only living on maybe things that aren't so consistent. You should probably stick on that 6-month side. Whereas let's say you've got Social Security. Let's say you've got a pension. Let's say that maybe you've got a trust that pays out as well, from some family or something like that. In that instance, I would be okay going on the 3-month side. But in an overwhelming majority of the recommendations that we have directly for our clients, when they're preparing for retirement, a lot of our clients that we see in the end fall on the 6-month side of that spectrum. Now, knowing how much to have set aside is one thing, but being able to know what to do with it really is the next piece. And what I like to see you do with that is put it into a high yield savings account. You'll see with a lot of the online banks, I don't have to name the names, but you'll see their names on commercials. And that's really where you want to park those monies. They pay strong interest rates. They've got quick and easy access to the money, and they're FDIC insured. So that's going to be a great resource and a great avenue to have your side and parked money put aside. And it has some purpose to it. We want to make sure that we don't have too much cash. And the reason being is because cash, when you rate it against inflation and taxes, and when you rate it against just the overall cost drag of not having invested, it's going to be the most losing investment when you look across the entire investment landscape. So you might hear some folks, or if you do some Google searching, say that cash is trash. While I kind of understand where they're coming from, I don't think I would agree with that wording or terminology in total. We just want to make sure that the cash that you do have is very thoughtful in the dollar value, very thoughtful in where it's placed, and any extra cash Let's make sure that it's working for your interest.
I love it. I love all these little tips that you have in there well as well about, finding the right bank and things like that. Because yeah, it's cash that you want to be able to access quickly. Within, I'd probably say like a 24-hour period, or just, a quick transfer away versus yeah, pulling it out of the stock market where it might be losing money at that time. Um, you got to have it at your call just in case.
Totally true. I've even had clients over the years ask, well, why don't we put it in bonds? And this is another one of those years where we realize even parking it in bonds, if you need to access it, you'd have to be selling low. So
Hmm.
this year's an interesting year. It's only one of 3 years in history where we've seen both stocks and bonds down double digits at the
Wow.
same time. So it's a really unique environment in that we're seeing both of the investments down at the same.
Hmm.
But what it does is it helps confirm and affirm what we're doing with our cash strategy, which is good interest rates. And to your point, Maggie, really accessible.
Exactly, exactly. And I like how you kind of threw some numbers out there of how to, it might be around 15 to 30,000 if you have about, 5 grand a month. Because I know it's also very common for women to keep a lot of money in the bank. That's one thing that like we're kind of known for, is to kind of overprotect in that way. So we want to definitely make sure we have enough, but then make sure, yeah, we're using the rest of that cash to the best as we can. Because like you said, it kind of loses money. It's a whole thing, but a lot going on there.
Well, I love that you said that. I'm actually making a note right now because I think that you may have teed up another thought point for a few questions down. So
Awesome.
it's important that I hear that because there's another tack that we're going to have in terms of being able to take care of some of those other cash desires or propensities.
Yeah. So then don't you recommend a couple like cash flow buckets that you use?
Took it right out of my mouth. So that's
All right,
exactly
let's hear
what
about
we do
those.
is we use the bucket strategy. When you look at the overall ways that you can create income from your portfolio, there's about, I would say, maybe 12 different strategies that are time tested and also academically proven to be able to help clients get money out of their investments or out of their portfolio. And what we do is we follow the bucket strategy. So we're going to talk in threes, I guess. So we've got three buckets. Bucket three is our investment portfolio. Bucket two is going to be our intermediary cash park, and bucket one is what we're spending. So one, two, and three. One is most liquid. Bucket one is your checking and savings account. That's where your transactions are flowing in and out. I also park, or I mentally park, that emergency fund in bucket one. And the reason being is because that's important for you. That's important that it's working in your interest and protection for you. But as a financial advisor, it doesn't necessarily need to be in under my control. In
Mhm.
fact, it really should be at a bank where you're not paying investment advisory fees, where you're getting a better rate of return than you would, say at one of the large banks. And then also you're going to be getting a better interest rate at your bank as opposed to like with a short-term bond investment or with another bond fund that may go down in value. So I like my checking, savings, and emergency fund in bucket one. Bucket two becomes the next horizon of a year's worth of expenses that we would spend out of the portfolio. We would take what we would spend in 1 year from the portfolio, we take that out of the portfolio, we park that in bucket two. Now, that's where we get a little bit of flexibility. William Bangen, who's the one who actually coined this bucket strategy, worked on some of the mathematics around that 4% rule that you may have heard of, which we'll talk about in a moment. William Bangen, when he went through his research, he said you should have 2 years worth of cash set aside. Now, back when he created this strategy, back when he did all of his academic research around it, it made sense. But that was nearly 20 years ago when interest rates were a lot higher than they are even right now. Interest rates are higher now. They're a lot higher than where they were a year ago. But when we look forward 2 years, we expect them to go back down. So we don't
Mhm.
expect to have 4% 1 year short term treasury. We expect to go back in the twos and threes. That's what the market expects, that's what financial advisors expect, as well as the Federal Reserve. So that's not a surprise to any of us. But what is important is knowing that if the market is a concern, or if the market scares you, or if your portfolio is maybe too aggressive for what you're comfortable with, we can add some cash and we can park it there in bucket two. Now, let's say, for instance, we've got 1 year's worth of cash distribution stuff that we would send off. We'll keep that in cash or money market or fund. Again, we don't want to subject it to any market movements. But then if you say, you know what, Jake, hey, I need more cash. I need to sleep at night. I can't call you and say the market's whipsawing, get me out. I can't have you do that. So what we would do is we would extend out that bucket too. Maybe put 2 years worth in there. Even Mr. William Bangan, who created this strategy, even he would be comfortable with that. So I'm okay. But again, if you're going to be able to have more cash, let's make sure that the investments that you're using, the safe investments that you're using within that area, is protected. Now, bucket three is that final one. That's the investments piece. And that's also one of the questions that we regularly get asked, which is, how much stock should I own? How much stock should I have? And which is a great question. I think one of the things that a lot of us have heard in the past is we've heard you take your age and that's how much you should own in bonds. A great adage, but one that worked in the past. It doesn't apply so much anymore. And again, because your bonds aren't really rewarding you. Yes, I get that you're getting paid more in your bonds this year, but when we look forward 2 years, you're not going to get the same level of reward. So,
Mm.
what we do for our clients, what we encourage you to do, is to be able to have a financial plan. We want to document what you own, what you owe, what cash income you will receive is, and we're going to take those pieces and we're going to say, hey, you know what? Based on those things, maybe you need $30,000 out of your investment portfolio. Maybe you need $3,000 per month, whatever it comes out to. And we're going to be able to help reverse engineer how much should be owned in US stocks, how much should be owned in international stocks, how much should be owned in bonds, how much should be owned in liquid alternative investments, things like real estate, oil and gas, infrastructure, and others. So it's a great way for us to look across the entire landscape and say, how much do you need from your portfolio and how can you get all of those to work in an efficient manner for you?
Yeah, it's a lot of great tips right there. But it's definitely also I see why you would get a professional is because after, kind of having that first bucket of your checking account and that emergency fund, there's a lot of other moving parts, predicting, knowing, about the interest rates and the bonds and what it looks like in 2 years. There's a lot of different things to kind of know and to have, in your mind at the same time. So it's really great just to have a professional who can help you guide through some of these things. Because it's not something you want to, as we know, investing is time and that time is magical. So you don't want to waste any time, doing anything wrong since we only kind of have one go at all of this. And so that's the great part about having somebody who can really help support you in that way, because it does get a little complex.
And I think those are all great points. I think one of the benefits of a group like Purse Strings is that we're taking it from thought and idea
Mm-hmm.
to practical application and personal reality.
Right.
And what I mean by that is, how do I empower you to be able to have some decisions on your own? How do I
Right.
empower you to have tools that maybe us insiders haven't know? Well, maybe we're all familiar with the 4% rule. And what the 4% rule says is you can comfortably live on a diversified portfolio and withdraw 4% of it for each year, and it will live with you forever.
Interesting.
And what do they mean by that? They're saying if you own 70% in US stocks, 30% in US bonds, and if you own that allocation forever, you could take out 4% year over year over year, and your portfolio will continue to grow and go. It will continue to live and work for you. So let's say that you've got, IRAs, 401ks, 403bs, and let's say you've got $100,000 in there. If you take out $4,000 per year or 4%, you'll be able to live with that portfolio forever.
Wow.
Now, that number might feel or sound a little small, and depending on your situation, it could go up, it could go higher or greater. And that's where being able to hone in on those numbers and say, based on my Social Security, is that $4,000 enough? Is my portfolio enough? Or how do I adjust those toggles to make sure that we're handling all these things at the right time?
Right, right, definitely, definitely. And so moving into Social Security, what should people do with their Social Security?
Um,
It's always, do I take it right at the, what is it, 59 and a half or 62? Or
yeah,
do I wait? Or, tell us the magic.
for sure. So that's another one of those simple yet totally packed questions.
Right.
And Social Security, you can take it as early as 60 in some unique situations. If you've got, maybe if you're a widow and you've got a
Hmm.
deceased spouse, you live with, married for over 10 years, you can take as early as 60. But really, the true earliest access point is 62. You've got full retirement age, which depends on when you were born. It depends on your birth year. It's somewhere between 66 and 67. Right now, it's around 66 and 4 months or 66 and 6 months. And then you can take it as late as 70.
Okay.
Now, that's great. That's a wonderful illustration. But when we've got this range, what Social Security is banking on is that people take it at full retirement age.
Hmm.
One of the interesting things, though, is that let's say that you don't take it at 66. Let's say that you take it later. For each year that you delay it, they actually give you an 8% increase.
That's a
And
lot.
that's huge. For a lot of our clients who we think could benefit from that, we very often tell them, wait to take it. Wait to
Hmm.
take it because that 8% increase is more than I'm going to get you in your portfolio in a
Right.
year. So go ahead and get that increase from Social Security. Take a little bit more out of your portfolio a little bit earlier on and be able to bank that bigger benefit.
And
So
that's definitely that's a payout that you see that increase every month. It's a long time difference, I feel like.
totally true. In fact, you don't even have to wait the full year. Like, let's say that your full retirement age is 66 and 6 months. Well, they actually give you that 8% is an annual number. So it's actually 8% divided by 12. That's the
Okay.
month over month increase that they give you. So
Wow.
let's say that you are supposed to retire at 66 and 6 months. Well, if you even wait 6 months and get your benefit at 67, they will increase your benefit by 4%.
Wow.
That's a pretty sweet deal.
Yeah.
On the opposite side, though, is something we do need to talk about too, which is the penalty.
Mm.
So it's not as it's not as important for me to press it now as what it used to be. If we look back about 15 years or so, nearly half of people who were eligible to take Social Security, nearly half of people used to take it at 62. I'm happy to be able to report that number's gone down. So about 1 out of every 3 people take it now at age 62. That's a blended number between men and women.
Hmm.
And the consideration from my part, or where I sit, is that when you take it early, they give you a discount or a penalty on what you would receive. Remember before we just got a promotion or an extra payout?
Yeah.
Well, if you take it as early as 62, they're only going to pay you about 70% of that full retirement age benefit. So if we want to be able to protect what we're going to get from Social Security, we should be taking it full retirement age or potentially delaying it from there.
Wow. Yeah, that's a big penalty. Um, but it kind of makes sense that, they only have such a pot of money to kind of distribute over your lifetime. And so if you start earlier, yeah, it is less money.
They sure do. Speaking of that pot of money, which we'll just make one quick little comment on,
Yeah.
is that if you do some Google searches or if you read the Wall Street Journal, I think even the New York Times had one recently on it, and they talk about the Social Security Trust. Will no longer be funded in 2035. Yeah, that's fair. There is going to be an expected decrease in benefits in Social Security's trust. That's not news. That's been around even from back when I was in college. Now, luckily, it's moved out. Before, back in the day, it was saying it was set to have adjustments in 2032. Now
Mhm.
it's set for adjustments in 2035. I don't think, and this is just me personally, this is not my company, this is not my boss, this is not my team, this is just the Jake thought of the day, is that I don't think that we're going to see the deaths of Social Security.
No.
I don't think that you retirees will be losing out on the benefit that you've worked so long for. And this is the reason why I personally believe that is because I don't know of a single Senate person or Congressperson who wants to have their name as the champion of the death of Social Security.
That's fair.
What do I think will happen is I think that Maggie will probably pay more in Social Security. Sorry, Maggie. I think
I
I'll
know.
probably pay more in Social Security. Sorry, me. I think our bosses will be paying more for their side of Social Security as well as for our side of Social Security. So when you factor those things in, I think that my full retirement age will probably be in the 70s at that point in time. I think that they have other levers to pull. I don't
Hmm.
think that they want to pull from taking from people who are currently taking their benefits,
Right.
especially because we know a lot of the voting population are also near or at retirement.
Those are great points to think about. I don't always think about, the people making those decisions. And yeah, if you had your name on that, you're not going to go down in history very well.
Not at all.
No, no, not at all. Um, so then I guess the last question I have for you today is how do you make your investments into cash? How can you build an interest portfolio that you can then live on?
Great question. And the interest portfolio, unfortunately, is one of those old adages. I think
Hmm.
you still can get some investments together that have strong interest rates or coupons associated with them, and then just clip them. But unfortunately, where interest rates are now, it just isn't as robust as it used to be. If you're going to be sitting in a high interest portfolio or a high dividend portfolio, you're going to only be owning utilities companies. You're going to only be owning bank names. You're going to be very, very concentrated in the companies that you own, which then really causes a whole lot of risk when it comes to the movement or the volatility of those sectors or individual company names. Where in today's world, what really does make sense is looking at the four pillars of retirement income, which is interest from our bonds, dividends from our stocks, and then we're going to be looking at taking our growth, so our appreciation out of the portfolio, and maybe even a mix of the principal or the base. But it's being able to look at how all of those work and walk in tandem with one another,
Hmm.
because we're going to make sure that we're getting a diversified portfolio, again, US, international, bonds, and beyond. We're going to look at being able to raise the right income levers and triggers at different points in time. Maybe we've got strong years like last year where we ended the year strong and we go ahead and we just take some of the profits off the table. Where it's years like this year where maybe we've only got a few successful winners. So maybe we lean more on the interest or more on the dividends or more on just those few successful sleeves this year to be able to
Hmm.
create that income. So it's being able to have a globally diversified portfolio, one that's right and great for your long-term goals, needs, and fit, but one that also is taking into consideration your cash needs and taxes to boot.
It's a great answer.
I wish that there was just like something easy. Unfortunately, the only something easy is just that you can't simply create a interest and dividend portfolio like you used to back in the day, because now there's just too much concentration, and having that level of volatility is a little bit rough. But instead,
Yeah.
being able to broaden our horizons and be able to think about taking interest, dividends, the profits, and some of the principal. Those are going to be the four pillars of being able to create income for you now.
Awesome, awesome. Well, this is all a ton of great advice that I think we've went through today. We covered a lot of topics through retirement, as we can see that, this is just kind of still skimming the surface. There's a lot of different moving parts here, but it's great to get some wheels turning, get some ideas of where your next steps might be, and how to kind of dive into retirement. Are there any last tips, tricks, pieces of advice you want to make sure to share today with our audience? Is there anything
Yeah,
we didn't
that
touch on?
Yeah, that's great. So, what I did was I kind of put together some questions. If I were you, what would I ask a financial advisor? I see that
Oh,
there's a
fun.
question over here, which I'll get to in a second, Aaron. So sit tight for me. But some questions that if I were you, I would ask my advisor are as follows. How much do you get paid for your recommended strategy? That goes for both investments and for insurance. I saw somebody at Starbucks the other day get buy something you probably didn't need. Next is, are you a broker or a fiduciary?
Hmm.
I'm a certified financial planner, which means I'm a fiduciary. What that means is I have to give a recommendation that's in my client's best interest versus a broker has to be able to present to them what's suitable or okay. So that's the difference of being okay versus having to have the best interest at heart.
Yep.
So as a CFP, I am a fiduciary. I work for Moneta, and Moneta is a registered investment advisor, which means as a company, they're also fiduciary. So we're both bound by that, as opposed to the other, which is a broker. I'm not here to say brokers are bad or fiduciaries are good. You can see where I sit, so you know where my personal preferences are. But I have a lot of great friends who are on the broker side. But again, just make sure that in either instance, you know who they are,
Yeah.
how they're working for you, and what they're being paid. Ask what are the fees within my portfolio.
Hmm.
Ask, are you being paid by the investment companies you recommend?
Oh, that's a good one.
Sometimes they get kicked back what are known as 12B1 fees. We don't need to get super technical, but sometimes they can get compensated by, recommending a fund over another. So just make sure that they tell you. They also have to have it in their ADVs. And then the last two are also very important. Do you have any negative disclosures against you on broker check?
Hmm.
And have you or your firm have customer complaints? Customer complaints have to be filed with the SEC. It's a compliance law. So once
Oh,
they're
wow.
filed, they're actually well known. So we want to make sure that clients are having a good strategy around that. We've got a question up here, which is, do you have any advice for obtaining health care for those who retire before they're Medicare eligible? And great question. And the nice thing is that the Obamacare system that we're now around, that we're now kind of subject to in the last 8 years, that gives us one really, really strong option. We can go down looking at each state has their own healthcare exchange, and
Yep.
you can go onto the healthcare exchange, and you can be able to apply for whichever insurance you want. The nice thing is that they have on there the high deductible health plans, which have those HSAs attached to them. Otherwise, they have more complete, or more higher premium, lower out of pockets, which are
Hmm.
either the HMOs or the PPOs. Um, you know, I'm more of a fan of the HMO PPO, but that's just because my kids are a little crazy and we don't want to pay those high deductibles. We would rather be able to go to the emergency room or be able to go to some extended care facilities or some quick care facilities without paying a whole lot out of pocket.
Yeah.
So the first place I would recommend is actually the state exchange. And in many instances, I almost also recommend that over Cobra coverage. And the reason being is because the Cobra can be more expensive in a lot of
Yeah.
instances over the state exchange. The state exchange just has a bigger pool of applicants. So with that, they're able to get better pricing. This is a really interesting year. I love that you asked this, Aaron. And the reason being is because some national legislation just went out maybe a month ago. And what it does is it's locking in the price for prescriptions 2 years
Nice.
in the future.
Nice.
So if you have prescription, what you need to be doing is you need to be asking your insurance company, are you covering my same prescriptions next year? Yes or no? If they
Mm.
are, great. What's my new premium? I have clients who have MS, and their MS medication is expensive. And
Yeah.
then their MS medication in this instance, I'm not saying this is across the board, in this instance, is nearly 14 times more expensive next year alone. So the insurance companies are going out there. Probably recorded saying this. The insurance companies are being ahead a little bit of that price lock-in 2 years in the future. It's just a simple way of me saying I highly recommend that you talk with the insurance company that may have already signed up for the year. And if
Mhm.
not, when you're on the exchange, really do a deep dive on prescriptions. That's a critical one for 2023 and 2024.
It's a great piece of advice because, yeah, I had no idea that was coming down the line. So those are great questions to ask.
So there's a group that we use, or we at least refer to every once in a while, and they're I-65 Medicare. So I-65 Medicare. I think they're a Minneapolis firm. They're great for being able to answer some questions around insurance and how it coordinates with Medicare. So
Yeah.
if you're around age 65, that's not a plug for them. I'm just saying we often use them. They're a great group that if you have questions and you're 63, 64, 65, feel free to give I-65 Medicare consultants a call. and then they'll see if they can even help you or give you any thoughts relative to those questions that you have.
Yeah, definitely. We also on Purse Strings we have some resources for some Medicare people as well as some health insurance people. Because I know as an entrepreneur, you just getting healthcare off the marketplace. I'm very experienced with that one. Um,
One of the
so
cool things there is that if you use some of the brokers that Maggie
mhm.
just referred to, on the medical side, on the insurance side, that's actually a good thing because they look across for the cheapest price
Yep,
possible.
yep.
They're often paid by the medical companies themselves or by the insurance companies in the end. So in a lot of instances, you may not pay for services if you use one of the healthcare brokers. So keep that in mind as you're looking or researching. Maggie's got some great references and
Yeah,
resources.
that was exactly my experience, and I was like, why wouldn't I go to somebody if they're free? Somebody else is paying them, so it's great.
Yeah.
But well, thank you, Jacob, for providing all this great information today. If anyone does have any more questions, please reach out to Jacob. He's happy to help you. I know you give a complimentary 20-minute call just to make sure it's a good fit. His email's been going through the bottom of the screen. He's also a Purse Strings approved professional, so you can check him out on our site, pursestrings.co. And yeah, jump in, get the conversation started, start planning for your amazing retirement. I'm so excited for everyone who's almost there. And we'll talk to everyone again soon. So thank you, Jacob.
You're so welcome, ladies. Thank you so much for being able to stay on the line with us. This is a great opportunity for us to give you a few good nuggets. To Maggie's point, I'm very, very happy and here to help. So whatever questions you have, feel free to give me an email. You can also call me at 720-579-9213. I am in Cherry Creek. We're just right outside of downtown Denver. But most people come to Denver just to fly through and go up to the mountains. So I can't blame them. But if you're here in town, happy to go grab a cup of coffee. If you're not in town, happy to be able to entertain that email or phone call. I'm here for you, complimentary for us to go through that initial consultation together.
Awesome. Well, thank you again, Jacob, and we'll talk to everyone soon. Bye.
Thank you. Bye-bye.